Welcome to This Explainer. Today, we're diving straight into the absolutely fascinating financial story of hardware manufacturer Bel Fuse Inc., and we're going to decode the real drivers behind their recent explosive market momentum. Now, if you follow the industrial, tech, and defense sectors, you already know Bel Fuse. They've been this super reliable, almost under-the-radar designer and manufacturer of advanced power and connectivity solutions for literally decades. But recently, well, their stock and their valuation have been doing things that are, frankly, turning heads across the entire market. It's wild. So today, we're going to pop the hood and break down exactly what's happening with this company, looking at their latest financial data and strategic moves right up through May 2026. Let's get into it.
All right, let's just tackle the elephant in the room right away with this massive number, 67.31. That is the current trailing 12-month price-to-earnings, or PE ratio, for Bel Fuse Class B shares as of May 2026. Now, for a traditional hardware and equipment manufacturer, a PE ratio pushing 70 is, well, it's incredibly elevated. It tells us that investors are willing to pay a heavy premium for every single dollar of earnings this company generates. The market is essentially pricing in an expectation of massive, sustained future growth. But a number like this doesn't exist in a vacuum, right? We really need to look at the historical context to appreciate just how dramatic this shift is.
And here is where the story gets super interesting. Check out this contrast. The company's 10-year historical average PE sits at just 5.10. Think about that. That means their current valuation of 67.31 is a staggering 131.97% jump from its historical norm. For a full decade, the market looked at Bel Fuse as the steady, predictable, maybe kind of slow-growth industrial player, basically valuing it at roughly 5 times its earnings. Today, they're being valued much more like a hyper-growth tech startup. So the big question we have to answer is, what on earth happened to completely rewrite the market's perception of this business?
Well, to understand the premium, we've got to look at their recent record-breaking growth. In the full fiscal year of 2024, Bel Fuse brought in $534.8 million in net sales. Solid, right? But fast forward to the end of fiscal year 2025, and those net sales absolutely rocketed up to $675.5 million. That is a 26.3% jump year over year. I mean, for a company that makes physical electronic components and power systems, we're talking rugged connectors here, adding over $140 million to the top line in a single year is just phenomenal. It highlights an unprecedented inflection point in demand for their specific hardware.
And you might be thinking, okay, maybe it was a one-off spike, but the momentum actually didn't slow down into the new year. When they dropped their preliminary first quarter results for 2026, revenue hit $188.5 million. Compare that to the $152.2 million they reported in the exact same quarter of 2025, and we're looking at a very healthy 17.2% year-over-year increase. The elevated demand is clearly holding strong, and it's continuing to scale. It absolutely proves that 2025 wasn't just a fluke or some delayed contract finally paying out.
But here's the kicker. It's not just top-line revenue driving all this market hype. They're actually becoming more profitable as they scale up. Look at their Q1 2026 gross profit margin. It expanded to 39%, up from 38.6% a year prior. Plus, they generated an impressive $34.5 million in adjusted EBITDA, which is a crucial measure of their core operational profitability. That represents 19.3% of their total sales. When a company can grow its sales by 17% and simultaneously widen its profit margins, that signals incredible pricing power and highly disciplined execution. For investors, margin expansion like this is a massive green flag.
Section 1. The catalysts driving demand. Let's look at what's actually fueling all this growth.
Okay, so what's the underlying engine here? This growth is anchored by some very concrete market forces. First up, management noted huge momentum in data center connectivity and high-performance computing, which is tied directly to AI-driven investments. We all know the AI boom requires intense power conversion and high-speed interconnects, and that's exactly what Bel Fuse makes. They're basically selling the picks and shovels for the AI gold rush. And on the defense side, things are just as hot. They've got 2 new defense design contracts in Europe moving through final certification, expected to wrap up in Q2 of 2026. Plus, they just secured their first bundled Cinch and Enercon agreement on a brand new U.S. defense design. These aren't just quick sales. These are incredibly sticky, high-reliability contracts that give them long-term revenue visibility.
Section 2, Strategic Expansion Mode. How they're capitalizing on the surge.
So management is definitely not just sitting back and watching the cash roll in.
They are in full-on aggressive expansion mode. In March 2026, they closed the acquisition of Datamate. That brought in fresh customers and new tech to expand their data solutions. Then in April, they completely realigned their business units. The goal there is integrated selling and tighter coordination across their engineering teams, basically getting everyone rowing in the same direction. And then just weeks later in May, they dropped a huge announcement, a major Class B stock offering. That May 12th announcement revealed a public offering of 1.3 million Class B common shares, with an option for the underwriters to pick up an additional 195,000 shares. Now, what you really want to pay attention to here is the heavy-hitting institutional presence. This offering is managed by absolute titans. Citigroup, Bowface Securities, and Wells Fargo Securities are the joint bookrunners. Having these top-tier banks backing the offering is a huge vote of confidence. It signals that the broader market really believes in Bel Fuse's growth trajectory and their ability to put this new capital to work.
And speaking of putting capital to work, they aren't just raising cash for the fun of it. There is a very specific, strategic roadmap here. Step 1. Pay down their current debt load, which instantly makes their balance sheet bulletproof. Step 2, and this is probably the most exciting part, is fully financing the remainder of their Enercon Technologies acquisition. They already owned an 80% stake, and this fresh cash lets them scoop up the remaining 20%. Step 3 leaves dry powder for other potential acquisitions. By issuing stock right now while their PE ratio is soaring, they are brilliantly using their high valuation as currency to fund tangible growth, without weighing the company down with expensive debt.
Looking ahead, management is extremely optimistic that the good times are going to keep rolling. They're projecting an incredible second quarter of 2026, expecting sales to hit anywhere from $195 million up to $215 million. If they actually hit the high end of that guidance, we're talking about another truly monumental quarter of growth. On top of that, they expect gross margins to stay super healthy, hovering right in that 38% to 40% range, fueled by robust orders across defense, commercial air, space, and, of course, those data solutions.
Which leaves us with the ultimate question to wrap up today's explainer. As Bel Fuse deploys this massive wave of new capital to expand its footprint in defense and AI data solutions, will their execution actually continue to justify this premium valuation? Look, the market has clearly priced in perfection at this point. Bel Fuse certainly has the powerful tailwinds of AI infrastructure and defense spending pushing them forward. They've got a freshly strengthened balance sheet and a newly optimized organization. But the pressure is totally on management now to prove that this new era for the company is a permanent reality, not just a passing phase. We'll definitely want to keep a close eye on how quickly they can integrate the rest of Enercon and Datamate. Thanks so much for joining me for this explainer, and I will see you next time as we continue to decode the market's most fascinating stories.